Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do." So we begin. Today is Tuesday, June 18th, 2024. In today's episode, I'm going to start by mentioning at the end of the episode, we're going to do a valuation of what I consider to be a Graham-approved stock. Granted, it's not currently at a Graham-approved price, but we're going to go through the way of calculating that as written in his book, The Intelligent Investor. This is a type of stock for what he would consider to be a defensive investor, something that would be approved for a portfolio of something safe and can offer good returns at the right price. Notably, tomorrow on Wednesday, markets are closed for Juneteenth. Data coming out today, we had retail sales that surprised the market a bit. The U.S. retail sales for May, the last reading of this was negative. My understanding is that we expected it to be more positive to make up for the last month because it kind of wavers up and down. Instead, we only creeped up a little bit, not as much as the market expected, and so that let yields fall once again and is starting to add to the frothiness of, the question of where are we right now in the economy? Is it hot? Is it not? Is it going to heat up from here, or is it going to keep cooling down into disinflation, deflation? And we'll see. I wanted to point out, a number that people haven't been talking about as much. The retail sales minus autos, I noticed, was, even more down than was expected. So I found that to be quite notable. We expected to go from negative 0.1 to 0.2% as well. And instead we got actually negative 0.1%. The market in many ways is waiting for flash PMIs coming out on Friday. And then after that, the next really big piece of data is next Friday, the Fed favorite inflation gauge, PCE data coming out. Jumping straight into the charts, we're going to start with SPX, the S&P 500, and once again, all-time closing highs. I'm getting exhausted of saying this, and this is momentum. This is a momentum trade. It's funny, I'm not the only one that's seeing this as it is. It's clearly just momentum. The machines and some people are crazy enough, apparently, every time it dips, well, it went up last time it dipped, so it'll go up again, and that it runs on itself until it runs out of fuel. And when it does, it just makes it that much more risky for it to collapse back down. The main signs that this is not a healthy bull market is volume is low. Number one, PE ratios are getting out of hand for some of these mega caps especially. And it's only really being driven by a few mega cap stocks. Most of the stocks are not doing so hot, and you can see that clearly again in the fear and greed index. The reason this is in fear is, because of the stock price strength and breadth. So overall, most stocks are not doing so well, but because of Nvidia and Apple and some of these mega cap stocks being so big and having such a huge weight in the S&P 500, that's why this just keeps going up here. Again, I do not believe this can go up forever, and I think that if it reverses, it could be quite violent, really. This is like the calm before the storm, the way I see it. HYT, high yield corporate, now that I'm reading, by the way, going through the chapters of The Intelligent Investor, it solidifies my idea that this really is this. If Graham was alive today, I believe he would be checking the value of high yield corporate every day as well. It's very important to see what kind of fear is in the smart money. These are bonds. These are supposed to be guaranteed payments, and if there's truly some bad things perceived at least to be coming, the price of this will go down and everything will really tumble down with it. Now, specifically today, we had an engulfing red candle of the past 2 trading days after a fake out of this tighter and tighter consolidation. This spells to me that it is very likely that for now this wants to head lower. Part of the reason of the importance of it being a solid candle is that, most of the trading goes on during the day, and there were enough professionals and people out there that actually bought this, overnight, or had orders that came in the morning and bid it up to a higher price, but then throughout the day it pushed it down all the way below the previous closing and opening lows of those 2 previous days. So it's a statement there, and the most likely scenario with that kind of candle is to continue breaking down. I wanted to bring up the Fed funds futures only because I've been noticing that ever since we had a flip of July basically stamping out much of a possibility of a cut in July, it's been rising day after day. Notably just yesterday it was at 8.3%, and now we're at 10.3% on the back of that retail news coming out a little weaker than expected. If, for example, we get to Friday and the PCE data also comes in weak, along with this Friday's flash PMIs, if those come out weak, which is, it can, that can have an effect. It can shock the market. But yeah, the main one being the following Friday, next Friday, PCE numbers coming out, personal consumption expenditures. If those both come in pretty weak, this could continue to add more favor to the idea of a cut in July. The next chart I wanted to bring up was actually Bitcoin. So there are a lot of lines all over the place on this chart, and we're going to start with, if you can see where my mouse is, I tried to make it big. We're going to start with this structure here. This is a bull flag, and we had these black lines here representing the flag here, clear breakout, right? And so, I was thinking, well, that means the target for this, I drew it out to be about 94,000 on Bitcoin. I was watching Gareth Soloway's show today. He's better at this than me, and I wanted to share with you his lines that he believes are in play here. Mainly we have a pivot low here to a pivot high here, and then you draw a parallel down to this low, and we cracked through that today. And the idea is, if we close today, I believe closing as in 8 o'clock p.m. Eastern Standard Time, then this could mean a very much larger move down in Bitcoin. Gareth Soloway has been very, very good at looking into his crystal ball and his chart patterns for Bitcoin, so it's worth paying attention to at the very least. The other trend line it broke, it also hits here, but then to this low, and then you pull up a parallel to this high here, I believe. Yeah, or I think so. But anyway, so it according, watch his Trading the Close show if you don't believe these lines. But yeah, so this could get quite bearish here. I think he believes that if it closes today, very notably, I believe he says there's a potential to get down to the 52,000 to 50,000 level in Bitcoin pretty quickly. Not a lot going on in TLT, but I like to bring it up more right now, partly because I believe that there's a lot of very strong patterns and fundamentals in economic data that, like I said in my last show, it seems like all stars are aligned for TLT to continue rising here. And we had a nice bullish decent sized green candle today. And to finish the main charts of the day, once again, SMH Semiconductors, another all-time high. Just absolute insanity. As well as in the triple Qs, it eked out. You can't see it too well, but we did actually close at an all-time high. By the way, this could represent a doji here, and I'm gonna say it. I said it a lot of times before. I think the top's in. I think we're going down from here, but we will see. On to the Graham analysis of valuing a value stock for the defensive investor. So basically a stock that you could buy very comfortably, and for someone that wants to be an active investor but doesn't want to take too much risk, but enough risk where you can get very nice solid returns. And his rules for one of these kinds of stocks, there's actually one more rule I'll talk about, but the first rule, main rule for figuring out the pricing of it, is that the PE ratio should not be higher than 25 for the average of the past 10 years of earnings for this type of stock. And also currently it shouldn't have more, the PE ratio shouldn't be over 20, no more than a current ratio of PE ratio of 20. The third rule is that the company should be in the top third of its industry, but that's like more of an arbitrary rule. It doesn't necessarily have to work that way. When you see this company, you will agree that it's probably pretty solid, and Graham would approve greatly, but the only thing missing is the price. And so, but we'll go through this valuation really quick so I can show you how to do this. So the company is Next Era Energy, NEE is the ticker symbol. It's currently at a price of $70.44. We'll zoom in to see a little bit better. The current trailing 12-month PE ratio says that it is 19.25. So that's a check. Graham would approve of this. The PE ratio, the current PE ratio is below 20. Check number one. I forgot another rule. It's supposed to have something like 20 years of solid increasing dividend payments. So we move over to historical data on Yahoo Finance. Anyone can do this. Time period, I just set it to the max, dividends only. And man, oh man, do we have a nice history. Whoops, I didn't apply it. Here it is. Man, oh man, do we have a nice history of dividend payments going back a very, 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 very long time. All the way to 1983 is when they've had non-stop dividend payments for an extremely long time. Now, is it a top player in its industry? I'd say it's top enough, okay? A market cap of $144 billion. It's been around since the 70s and has been paying dividends since the early 80s, non-stop. This is a Graham-approved stock. Now we just have one other metric to try to figure out, which is this one right here. Does it have a PE ratio of 25 for the average of the past 10 years of earnings? So to do this, we're going to go to macrotrends.net and we're going to search for NEE. And you can see a list here, and I'm going to go straight to earnings per share, and I'm going to click it, and I'm going to scroll down to, they have a nice little list here, which is especially helpful for getting the numbers exactly right. So 10 years would be from 2023 to 2014. So then we press copy. Let's try that again. Copy, and I'm going to open my Chat GPT, and I'm going to click paste, and I'm going to say find the average. Don't make a mistake. You have to tell it to not make a mistake, because I swear sometimes it does. But here we go. Analyzing. So they calculated it out to be $2.17. So now all we have to do to find out what the cost of the stock should be with a PE ratio of 25 based on this average earnings over the past 10 years, we just copy that into there and do times 25. And there we have it, 54.25. So, you know, the current price at $70 has a current PE ratio of less than 20. However, the past 10 years of earnings show us that the number for this other metric actually needs to be a bit lower at 54.25. Coincidentally enough, if we take a look at the recent history of the price of this chart, we see that this was in a gram buyable range through in October of 2023, and then we got above it. He might have sold there, you know. I believe he generally sells when it becomes overvalued, and he usually looks for a 30%. If it goes up by 30% over what he considers to be a good value, he'll sell it because he thinks it's perfectly fine. And I think it's funny, we dipped down just near that 54, 54.97. It may have even bottomed. Oh, it looks like it did. If you look at this candle, let's do it. If I stretch this out here, the bottom of that wick there, it was below his price of 54.25 at 54.02, and then since that price was achieved, we've had a heck of a bull run all the way up to $80. That is a large return from 54 to 80. I believe it comes out to about a 50% return if you had sold it at that top there. Graham would have sold it before it got up to there. He'd be happy as a clam selling it in the 60s, I'm quite certain. So this stock is currently on my shopping list at that price, and as a defensive stock to hold for, well, until it becomes overvalued again, I guess. That's all I have for you for today's show. I hope you enjoyed, and thank you for watching. Robschild.